In a groundbreaking move, the United States and United Kingdom have unveiled a new roadmap for stablecoin and tokenization regulations. This landmark framework promises to reshape the landscape of digital assets significantly. Here's what you need to know about this historic announcement. Looking ahead, the recent establishment of a comprehensive regulatory framework for digital assets is poised to significantly influence global financial markets. This development is expected to encourage other major economies, including the European Union, Japan, and Singapore, to pursue similar bilateral or multilateral agreements. Historically, regulatory fragmentation has hindered the growth of the digital asset sector, creating barriers to entry and fostering uncertainty among investors. As nations begin to align their regulations, we can anticipate an acceleration in global regulatory harmonization, resulting in a more cohesive and stable environment for digital assets. The new one-to-one reserve requirement for stablecoin issuers presents a pivotal challenge, likely reshaping the market towards providers that prioritize transparency and rigorous auditing. This shift may enhance consumer confidence and foster greater institutional participation. Additionally, platforms for tokenized assets, such as those operated by the Depository Trust and Clearing Corporation, DTCC, are expected to broaden their cross-border operations between the United States and the United Kingdom, facilitating enhanced financial integration and collaboration. Moreover, as regulatory risks diminish, we may witness a surge in investments in crypto exchange-traded funds, ETFs, and institutional products, particularly those associated with Ethereum, which has recently drawn $1 billion in new investments. The evolving regulatory landscape raises critical questions about its impact on cryptocurrency adoption and innovation. As we look to the future, the interplay between regulatory advancements and market dynamics will be crucial. Stakeholders must remain vigilant in adapting to these changes, as they will shape the trajectory of the digital asset ecosystem. Observers should closely monitor how these developments will influence the strategies of both established financial institutions and emerging crypto startups, particularly in fostering innovation and enhancing user trust in digital currencies. The groundwork for this landmark regulatory announcement began earlier in 2026, when the United States passed the Genius Act, establishing federal guidelines for stablecoins. This legislation represented a significant step toward creating a regulatory framework designed to protect investors while fostering innovation in the digital asset space. It aimed to address the growing concerns over volatility and security in cryptocurrency markets, which have faced scrutiny due to high-profile collapses and fraud cases. Concurrently, the UK's Financial Conduct Authority, FCA, intensified enforcement efforts, recently conducting raids on 8 locations suspected of illegal peer-to-peer crypto trading. This marked a notable shift towards stricter regulatory oversight in the UK, reflecting a broader global trend towards tighter regulations in the crypto sector. The urgency for regulatory alignment was further underscored by global exchanges preparing for the anticipated decision by the U.S. Commodity Futures Trading Commission, CFTC, to allow perpetual crypto futures trading, which would significantly reshape trading dynamics and attract institutional investors. Institutional players, particularly BlackRock, have been advocating for tokenization, eyeing an estimated $114 trillion in stocks and treasuries that could be affected by these developments. This push for a unified regulatory standard ultimately set the stage for the joint announcement, marking a pivotal moment in the evolution of cryptocurrency regulations. The impact of these regulatory developments is profound, as they signal a new era of legitimacy and oversight in the cryptocurrency market. Investors can expect clearer guidelines that promote safety without stifling innovation. Looking ahead, the collaboration between the US and UK regulators may pave the way for a more cohesive international regulatory framework, fostering greater trust and participation in the digital asset ecosystem. As these regulations take shape, they could redefine how cryptocurrencies are integrated into traditional financial systems, establishing a new paradigm for global finance. The unveiling of this regulatory roadmap marks a pivotal moment for institutional adoption in the cryptocurrency sector. The new framework aims to clarify the rules governing digital assets, which has long been a barrier to entry for traditional financial institutions. Historically, the absence of clear regulations has created an environment of uncertainty, prompting banks and investment firms to adopt a cautious approach towards crypto assets. This hesitancy has stunted innovation and slowed the integration of cryptocurrency into mainstream finance. With these guidelines now established, cryptocurrencies are becoming increasingly attractive to investors who prioritize stability and compliance with regulatory standards. The introduction of a one-to-one reserve requirement for stablecoins is particularly significant. This requirement is designed to bolster confidence in major stablecoins such as Tether, USDT, USD Coin, USDC, and Ripple's RLUSD. As these digital currencies gain legitimacy through stringent oversight, they are poised to see heightened adoption rates in decentralized finance, DeFi applications, and cross-border transactions. The roadmap also lays the groundwork for the expansion of tokenized asset markets, such as BlackRock's tokenized treasuries. With coordinated international standards, these markets could facilitate a broader global reach, potentially transforming how assets are traded and managed. The impact of this regulatory clarity extends beyond institutional players. For everyday consumers, it translates to a more secure environment for digital transactions and investments. The increased legitimacy of cryptocurrencies may lead to wider acceptance in daily financial activities, such as purchasing goods and services. As consumers feel more confident in the stability and security of these assets, the likelihood of integrating cryptocurrencies into mainstream financial practices grows. Looking ahead, the potential for growth in regulated stablecoin projects is substantial. This regulatory roadmap could trigger a wave of investment into these assets, accelerating their development and integration into traditional finance systems. As more financial institutions embrace cryptocurrencies, we may witness a paradigm shift in how we view and utilize digital currencies. The evolution of these regulations signifies not just a regulatory milestone, but a transformative opportunity for the broader financial landscape, setting the stage for a future where cryptocurrencies play a central role in everyday transactions. The next few years will be crucial in determining how quickly this transformation unfolds. On July 15, 2026, the United States and the United Kingdom unveiled a comprehensive joint regulatory roadmap aimed at stabilizing the burgeoning sectors of stablecoins and tokenization. This initiative represents a landmark collaboration between the two leading global financial centers, marking the first substantial bilateral framework dedicated to digital assets. Among the roadmap's key components is a directive mandating that payment stablecoins be fully backed one-to-one by high-quality liquid assets. This requirement aligns with the recently passed U.S. Genius Act, which seeks to clarify the regulatory landscape for stablecoins, ensuring that these digital currencies maintain their value and reliability. In addition to the backing requirements, the roadmap facilitates cross-border market access for tokenized finance, HON, fostering collaboration on standards for tokenized stocks and U.S. treasuries. This is particularly important as financial markets increasingly embrace digital assets, which promise greater efficiency and accessibility. Another essential element is the establishment of a digital money interoperability system, which is expected to streamline global transactions between the US and the UK, thereby reinforcing their financial interdependence in the evolving digital asset space. The significance of this announcement extends beyond its regulatory content. It arrives at a time of intensified scrutiny surrounding financial technologies in both nations. Regulators have been grappling with the challenges posed by cryptocurrencies and digital tokens, seeking a balance between innovation and investor protection. Unlike previous regulatory efforts, this roadmap represents a collaborative approach, signaling a commitment from both governments to nurture innovation while safeguarding consumers. The impact of this initiative is likely to resonate throughout the global financial ecosystem. By establishing clear guidelines and fostering cooperation, the US and UK are positioning themselves as leaders in the digital asset arena. This proactive stance may encourage other nations to adopt similar frameworks, potentially leading to a more harmonized global regulatory landscape. Looking ahead, the successful implementation of this roadmap could set a precedent for future international collaborations in financial regulation. As both countries refine these standards, we may witness a transformative shift in how digital assets are perceived, paving the way for enhanced security and greater public trust in the digital economy. As we navigate this new regulatory landscape, what implications will it have for cryptocurrency adoption and innovation? Share your thoughts in the comments below and subscribe for daily deep dives into the world of finance.